Hi.
You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio or anytime. And let me remind you, if you ever have any more finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly at 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are no operators standing by. I am it.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan or plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. National Pie Day today, and fortunately it's not the one you eat. Yes, 314, 3.14, that is pi if you are a mathematician or if you are one of those folks who enjoy a little engineering. I think they use, I don't know, I'm not too much of an engineer, so I believe they use pi as well in engineering. I'll just stick with National Potato Chip Day today because that's a little bit more fitting for my lifestyle. Dow Jones Industrial Average checking the markets down 30 points right now. Oil down 78 cents a barrel, looking at 47.62 a barrel. The national average of gasoline, $2.29. That's the national number based on AAA's latest information. Here in California, we're still paying a little bit over $3 a gallon on the average. Over $3 a gallon is our average here in California. So that's just one step right there to let you know we like to tax ourselves here. So part of that idea, if you want to have a little bit of extra sales tax or a little extra gas tax, California is the place for you. I'm not going to sing, no, don't even get any ideas. That's not my cup of tea right there. Seeing the U.S. 10-year Treasury dropping a little bit. 2.595 is the yield on the 10-year Treasury. It's a little good news for those of you who are thinking about buying a house. The 10-year Treasury, again, down ever so slightly. The PPI inflation number stronger than expected. February's PPI rose 0.3% from January, above the consensus for an increase of 0.1%. And it was 2.2% higher than a year ago. Core PPI, which excludes food and energy, increased 0.3% above the consensus for an increase of 0.2%. And core PPI was 1.5% higher than 1 year ago. Just a few little numbers in there for you. Governor Brown, hey, he's back at it again. Now, here's the issue. Once again, we're used to these things here in the state of confusion. But Governor Brown, oh man, how do you continue with this guy? Raising gas tax by 42%.
This is ridiculous.
In order to cover the public pension insolvency. Public pensions, amazing. Now, think about this when we comes back toward our time of the year where we are back to dealing with politics, when we've got the campaigns going, when we get into the campaign for mayor, and you start seeing that there are more of these advertisements from the public employees unions. Yeah, they're the ones that don't have the money that they campaign. Here's the idea. It's a little bit of incestuous maybe, conflict of interest probably. But here's the thought. Who controls the contracts for the public employees unions? Well, it's the governor and the state legislature, right? And then who does the public unions put their money behind when it comes to advertising? Yeah, the ones that are going to give them the biggest raises. And now you and I, as the non-members of the Public Employees Union, get to pay for this public pension insolvency. So they're raising the gas tax by 42%. Now, here's the beauty of this. Who's paying that 42% gas tax increase? Well, it's not going to be the wealthy who are out there buying Teslas. No, they're not the ones that are paying it. It's going to be the average Joe, the working person who does not have the electric car, who does not have the hybrids. Those are not the people that are going to end up getting that benefit. They get to pay the extra gas tax. Unbelievable. But that is Governor Brown. He is right here in the state of confusion. We get to enjoy his policies. Speaking of adding to expenses, the final numbers or the latest set round of numbers are in for President Obama, adding nearly $8 trillion to the national debt. $8 trillion added to the national debt from President Obama's administration. Now, if you remember, here's the beauty of listening to these things, is we now have these wonderful tools called recorders. Everybody's got one. Everybody's got a phone with a video on it. Well, you can go back and listen to President Obama when he was running for office, criticizing President Bush for leaving the country in considerably more debt than it had when he first took office. And President Obama added nearly $8 trillion in debt, almost as much as all prior presidents combined. So if it was irresponsible and unpatriotic for President Bush, what should we say about President Obama? Just a simple question. I'm a simple guy. Just thought I'd throw that one out there to see where do you stand on that one? Let me know. Ron at ronsiegelradio.com. You can email me, or you can go to our Facebook page. You can put the comments right there. If you're watching us right now, Facebook Live, we've got the broadcasts on Facebook Live. You can check it out right there as well and put your comments in there. One of the nice things, though, right now, whether you agree with the idea or you voted for President Trump or not, he is our president. And one of the things that we can expect from a business person is for them to act like a business person. It's kind of a way it goes right there. So what do you think? Business people understand the idea of balancing a budget. They can't just print extra money. And if the reports are accurate and President Trump does not have a tremendous amount of debt from his own businesses, maybe he understands the idea of budgeting. Maybe he understands the idea of maintaining a budget. Be nice to see if that's the case, wouldn't it be? Well, one of the things that he's talked to his entire cabinet about, and one of the things that a lot of successful business people, and I think that without question we could say that the cabinet of this president has a lot of successful business people right there. Maybe they'll have a way of going in and cutting some of the expenses from the federal budget. So the national, and we've talked about this one a lot. The Corporation for Public Broadcasting might be privatized. That's a good thought. So here's some of the ideas that we're seeing going around. Department of Commerce and Energy would see major reductions in funding. Programs under their jurisdiction either being eliminated or transferred to other agencies. The Department of Transportation, Justice, and State would see significant cuts and program eliminations. The Corporation for Public Broadcasting would be privatized, while the National Endowment for the Arts, they're the ones that put these shrimp on treadmills to see how they like it. That'd be privatized or would be eliminated entirely. And the overall blueprint being used by Trump's team would reduce the federal spending by $10.5 trillion over 10 years. Now, again, I am a simple person. That works out to about $1 trillion per year. If you can save $1 trillion per year, we might start cutting into our national deficit, and we might even get a balanced budget. That would be something nice for a change, having a balance. So I think Newt Gingrich was the last one to have a balanced budget. One of the areas they're talking about, and this one I'm sure will come with some controversy, is defunding Planned Parenthood. Now, here's one of the issues. If you defund Planned Parenthood, there is another issue that we'd have to talk about. And obviously those who love Planned Parenthood will not chat about this one at all. Think about all the extra kids we're going to have in the marketplace, all the extra kids we'll have running around because Planned Parenthood is gone. Think about that concept. I know they're not going to like that idea, but I'll talk about it anyway. More on the Trump effect. U.S. Steel looking to hire 10,000 new employees. Where are they going to get 10,000 new employees when the liberals tell us we're at full employment? Well, we know where that's coming from. Wendy's, they're looking at getting rid of employees because they're automating their order-taking process. They don't like the idea of $15 an hour. Maybe they like the idea, but they just can't afford $15 an hour for people to take your order at Wendy's. So they're looking at automating with self-service kiosks to help them solve that minimum wage issue. They can hire less people. Think about this idea, and I'm a big user of this type of tool because I don't know about you, but I like the Starbucks app. And I'm not a fan of Starbucks. I don't like their politics. There's a lot of other areas that I'm not a fan of. But one of the things that I like is that app where I can place my order on the app. I don't even need to wait in line. It's got my credit card right there. I've paid the bill right there. And I don't have to worry about it. I walk into the store. My order's already ready. I say hello to the baristas, the workers there that are still remaining. Grab my drink and I'm on the road. Saves me some time. I can do it. Not while I'm driving because that would be illegal. But I can do it. I can pull over to the side of the road and put my order in. Most of mine is a repeat. Those of you that are like me that are just creatures of habit, you just order the same thing over and over again. It's no big deal. So that is the concept right there that we're looking at with Wendy's, going and getting rid of some of their staff. Maybe those people will go and get some really good jobs over there at U.S. Steel. Just a thought for you. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, low down payment programs attracting millennials, where millennials pay the highest taxes, mortgage interest rates up again. Should I wait to buy a house? We'll talk about it. U.S. debt is on the rise, and the CBO report on the repealing of the Unaffordable Care Act. All that and more. You can reach us at our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Connect with us, facebook.com/Ron Siegel Radio, on Twitter at Ron Siegel. Stay tuned. We'll be back in just a few.
Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
What if your family business could help clothe a less fortunate family? Or your restaurant could feed truly hungry people? What if you could help to comfort the lonely? Plant sustainable resources where nothing has ever grown before? Or make a child's lifelong wish come true? What if all you had to do was simply do nothing more than what your business already does every day? Would you do it? Introducing Processing for a Cause, a unique program that turns a percentage of your business's credit card volume into ongoing donation dollars for nonprofit organizations and foundations. Simply switch your credit card processing provider to Processing for a Cause and begin supporting a worthy cause today. The process is simple, and the cause will change lives forever. Processing for a Cause.
Are you a veteran, own a home, and need money? The Siegel Lending Team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel Lending Team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694552.
Are you a veteran, police officer, firefighter, doctor, nurse, or teacher? If so, you qualify as one of Ron Siegel's VIP heroes, and we have rewards up to $5,000 or $10,000 when you buy, sell, or refinance a home with one of the Ron Siegel radio partners. As one of the heroes, real estate agents will rebate part of their commission. Lending partners will give a credit at closing. The title company has special published rates, and many other service providers have incentives too. All you need to do is call Ron Siegel Radio at 1-800-306-1990. That's 1-800-306-1990. Or visit VIPHeroProgram.com. Just think about what you will do with all the rebates and incentives from the partners of Ron Siegel Radio. Just call us at 800-306-1990 so we can show you our appreciation for your service.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Text PAIR, P-E-A-R, to 79564, PAIR, P-E-A-R, to 79564. With a 3-minute survey, one of the real estate professionals are going to get back to you with the true equity position of your home. Now, you can't get that on these online tools. They just don't have enough information for you. So one of our real estate professionals can help with that. Love that concept. The low down payment programs are attracting millennials. Down Payment Resource reports that in January, 65% of first-time home buyers only put down a 0 to 6% payment. 0 to 6 was 65%, a decrease from 66% in December. Among all buyers whose transaction closed in January, 62% of those who obtained a mortgage made a down payment of less than 20%. Think about that, 62%, less than 20%, the same percentage as in December. However, the percentage increased for other types of loans. According to Ellie Mae organization, their Insights report, average down payments for January included all loans. Loan to value 78%, 22% average down payment. FHA purchases were loan to value 96%. That was a 4% average down payment. You know that you can do that at 3.5%, but some people do a little bit more. Conventional purchases, loan to value 80%, was a 20% average down payment. VA purchases, loan to value 98%, or a 2% down payment. VA loans have a 0 requirement. But if you go into the bigger properties, here's a big misconception. Yes, you can buy a $1 million home with a VA loan. It just requires a little bit of a down payment. There are some new programs targeted to home buyers who do not have adequate money for down payments on a home. Overlooked and disadvantaged communities may also soon benefit from these funds. Last year, more homes were sold in America than any year since 2006. Yet the housing recovery is bypassing dozens of communities and millions of Americans, according to the Down Payment Resource, a service that tracks approximately 24 home buyer programs. By giving buyers an incentive to choose a home in languishing neighborhoods, these programs are catalysts for change, according to Rob Crane, CEO of Down Payment Resource. New owners invest in their communities, stimulating growth and community revival. Down Payment Assistant can leverage a minor investment into turning communities around and putting young families on a path to home ownership. Funds for down payments are available through federal programs like the Treasury Department's Capital Magnet Fund, TARP's Hardest Hit Fund, that may be able to help. In addition, state housing finance agencies are launching new down payment assistance programs to bring the housing recovery to overlooked urban and rural neighborhoods. In addition, innovative state and local housing finance agencies are the key to turning federal initiatives into local opportunities that improve lives and build communities. Think about all these different opportunities out there. Why would you be renting? Why would you not at least make a phone call to us at 800-306-1990 to see if one of these down payment assistance programs might be good for you? Do I know if they're good for you? Not a chance. Do I know that renting is good for you? Not a chance. Renting is not going to be the right way to go. That's very, very rarely. When would renting be a good option? Basically, the only time renting is really a good option is if you know you're only a short term in a specific area. If you get transferred a lot, renting might not be your best option. But any other time, you're better off buying, and even our veterans, you're much better off buying a house wherever you're stationed. If you get relocated, well, use that property that you were in for a rental property to a fellow veteran, and you can buy again in the new neighborhood. Think about that concept. So one of the areas that we're also looking at is where are millennials paying their highest taxes? And there is a report out, the 2016 edition of an annual study, seems to suggest that millennials are in a financial pickle. For starters, they earn less than their parents did when they were young adults, plus the average millennial has over $30,000 in student debt. For millennials who are struggling to boost their net worth and make the leap to home ownership, the last thing they likely want to face is a large tax bill. But unfortunately, high tax rates are a reality for many millennials across the country. Study-specific Smart Asset wanted to find the cities where millennials have the highest tax bills, so they looked at 5-year estimates of median household incomes from the Census Bureau's 2015 American Community Survey. Then they used the income tax calculator to estimate the federal, state, and local tax burden for millennials in the 100 largest U.S. cities. They included FICA taxes in the analysis, but excluded sales and fuel taxes. For the purpose of the study, younger millennials are adults between the ages of 16 and 24, and older millennials, adults between the ages of 25 and 44. The key findings of the report: taxes are high for mid-Atlantic millennials. Isn't that a surprise? In the mid, easy for me to say today. Taxes are high for the mid-Atlantic millennials. The effective tax rates are high for younger millennials in Baltimore, Maryland, and 3 cities in Virginia. Young adults in places like Arlington, Virginia, earn more on average than their peers and therefore pay more taxes. Older millennials take a hit on the West Coast. Surprise! High income taxes are nearly unavoidable for many adults between the ages of 25 and 44 who live in Portland, Oregon, and some of the biggest cities in California. If you head to Texas or the South, younger and older millennials who pay the lowest taxes live in the Deep South or in cities like Laredo or Lubbock, Texas. Where younger millennials pay the highest taxes: Arlington, Virginia, Chesapeake, Virginia, New York, New York, surprise, Portland, Oregon, Virginia Beach, Honolulu, Aurora, Colorado, Baltimore, Maryland, San Jose, California, and San Francisco, California. Where are the older millennials paying the highest taxes? Well, Washington, D.C., Oakland, California, Fremont, California. Those are some of the areas where we're seeing lots and lots of tax. Wonder why they moved to those areas. I know there's some good jobs in some of those areas, but some of the things it doesn't make sense to me why people keep moving, especially if you're starting a family. When you're starting a family, you've got the opportunity to go where you want to go, and there are a lot of people out there that are just voting with their feet. They decide to vote and go to those Texas areas where they don't have as much in the way of taxes. Now, they make up for it in other arenas in those areas, but for the most part, people have a choice, and they're getting to make those choices. So we do look at, from time to time, what is some of the news items of the day with regard to real estate. Lynn Franco, the director of economic indicators, consumer confidence increased in February and remains at a 15-year high. Consumers rated current business and labor market conditions more favorable this month than in January. Expectations improved regarding the short-term outlook for business, to a lesser degree jobs and income prospects. Overall, consumers expect the economy to continue expanding in the months ahead. According to Ralph McLaughlin, Trulia's chief economist, I quote, driven in part by a healthy economy and near historic low inventory, the U.S. housing market is showing signs of picking up steam. Home prices in December were the largest in 2.5 years, and home buyers should expect the quickening of price gains to persist this buying season. The Wall Street Journal had a report, and I'll quote them as well. Even though Denver overall saw an 11.4% increase in year-over-year median sale price in 2016, the top end of the market has shown signs of softening, according to the Denver Metro Association of Realtors. The number of $1 million plus homes sold in December dropped over 26% from the previous year, with prices down 4.85%. So we are seeing some areas, and I think Melinda Johnson mentioned this recently when she was on with us, that there are some areas where we are seeing some price, or not price declines, but we're seeing the slowing of sales. Brent Humphreys was telling me off air yesterday that he's working on a property in Rancho Santa Fe that they figure it'll take 6 months to sell, but it's a $3 million house. Just a thought there. Year-over-year change in prices. What came in, 6.15% was the average according to the FHFA. Now, I love FHFA. And I'll tell you why I love FHFA so much when we're talking about pricing, is they only deal with the prices of the government programs. So when you're talking about the real high-priced properties that could skew median prices, they don't count those. They're only going up to either the 417 number or in some areas the mid-600 number. So in the Pacific area, the Pacific region, 7.44% year-over-year price change. 6.15% was the full country. Here in California, 6.6% was our year-over-year price increase. Just a thought for you to be aware of when you're looking at what's going on in prices in the real estate market. No sign of slowing, being that we still have a very, very tight supply of inventory of homes for sale. And we're still looking at a difficulty in getting listings. There's more demand than there is supply. That means prices should continue to rise. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, we're going to chat a little bit about mortgage interest rates. They went up again. Should you wait to buy a house? And U.S. household debt on the rise. The CBO discusses the Trump's version or the Republican version of the Obamacare, what the repeal and replace looks like. There might be some surprises that you may not be thinking of in there. We'll chat about that as well. Remember, you can reach us anytime. Our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Connect with us, facebook.com/Ron Siegel Radio, on Twitter @Ron Siegel. And if you miss any part of our broadcast, shame on you. But the replay is available, Ron Siegel 1 on YouTube, Ron Siegel the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Siegel Lending Team offers you buying power. Let's say you can afford a monthly mortgage payment, including principal and interest, of around $1,900. With today's rate on a 30-year fixed mortgage of 3.75%, APR 3.85%, that payment could support a $416,000 mortgage. But if you wait and rates tick up to around 6.5%, which is roughly the average home mortgage rate over the past 30 years, that same $1,900 mortgage payment, including principal and interest, may only be able to support a $314,000 mortgage. That's over $100,000 worth of home you're you're missing out on by waiting. That's buying power. All you need to do to get started is reach out to the Siegel Lending Team at 800-306-1990. That's 800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Payment example excludes taxes and insurance. Call us for full details, 800-306-1990. That's 800-306-1990 or SiegelLendingTeam.com. Equal housing lender, licensed under NMLS number 217037.
Is your credit score over 800? Are you living in the home of your dreams or simply where you think you can afford? Are you earning a safe, secure 10+% return on your investments? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
Are you purchasing or own a luxury home? If you're like so many others, your home is your largest asset and the mortgage is your largest debt. The Siegel Lending Team has some amazing financing opportunities right now. Jumbo loans up to $2 million, 30-year rates below 4%, 15-year rates near 3.5%, and if you can believe it, 7-year interest-only hybrids in low 3s. The Siegel Lending Team has all the options for your jumbo or second home loan requirements. Take advantage of them while you can. To learn more about all the other financing products available from the Siegel Lending Team, call 1-800-306-1990. That's 1-800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Again, call 1-800-306-1990. Rates subject to change without notice. Licensed by NMLS ID 217037 and 145502. Equal housing lender.
Do you own real estate or have assets over $150,000? Do you know one of your heirs will be the courts and the IRS? If you don't have a living trust, you will go through probate. Call Heritage Financial Services toll free at 1-855-434-7400 for a free review. Check us out on Facebook, Heritage Financial Service in Lake Forest, California. That's 1-855-434-7400. Again, 1-855-434-7400.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Word on Wealth segment today being brought to you by AskAboutReverseMortgages.com. If you are 62 years of age or older, have some equity, maybe you want to buy a new house and never ever make a mortgage payment, the reverse mortgage might be the right answer for you. Let's chat. U.S. household debt on the rise again. That is the subject today of our Word on Wealth segment. 2000 financial crisis led to a noticeable dip in Americans' debt and spending levels. Since the recovery began, however, Americans' debt levels have been creeping back up. In fact, recent indicators show that our total debt levels are almost where they were in the pre-crisis 2008. Recently released data from the Federal Reserve Bank of New York reveals that the U.S. household debt levels back up from their recession lows. The latest quarterly report on household debt and credit from the Center for Microeconomic Data shows that total U.S. household debt increased by 1.8% in the fourth quarter of 2016. Total household debt is a figure that includes both mortgage and non-mortgage debt. As of December 31st, 2016, U.S. households' debt equaled $12.58 trillion. And as I mentioned, that's up 1.8% above the debt levels of the third quarter of 2016 for an increase of $226 billion. Household debt is now close to the pre-recession peak. Our current household debt is just 0.8% below the peak levels, which we hit in the third quarter of 2008. So does that mean we're forgetting the lessons we learned during the recession or that our economic fortunes are improving? However you regard the change, it certainly is significant. When total household debt in the fourth quarter of 2016 was 12.8% higher than its lowest point in the second quarter of 2016. American debt comes from a handful of different sources. Mortgages always make up the largest single portion of U.S. household debt. Non-housing debt, which includes credit card debt, auto loans, and student loans, total $3.62 trillion in the fourth quarter of 2016, well below the household debt, mortgages, and home equity lines of credit for the same quarter. Housing debt totaled $8.95 trillion. The CMD found that HELOC, home equity lines of credit debt, was relatively flat, while mortgage debt rose $130 billion. What does all that mean to you? Well, here's the issue, is if you bought a house, many people, we talked about this in the last segment, about how many people are buying a home with less than 20% down. The vast majority of people buy homes with less than 20% down. There's mortgage insurance in some instances. Sometimes you're dealing with a home equity line of credit so that you don't have to pay the mortgage insurance. What I want to share with you is those things are great. There's no problem. My book, mortgage insurance, the FHA loan, all of those things, no problem in my book with any of those. What the issue is you need to be able to plan your life and plan your finances using the mortgage as much as anything else. A lot of folks back out of this concept. A lot of folks say, you know something, they're not interested in that retirement program that I've talked to you many, many times about, on how to retire on $18,000 a month with no 401k, no IRA, simply using your mortgage and your real estate. Because your real estate is generally going to be your largest asset. Now the question becomes, are you going to use that asset or are you going to waste that asset? What I mean by waste the asset is when you have a lot of home equity, that's like putting your largest investment is in cash under your pillow or under your mattress. Not a wise place to invest money. So what I want you to do is get that money out of there. If you're not refinancing your property every 5 to 7 years, especially here in Southern California, I know that when you listen to people like Dave Ramsey, they say pay it off. They're also talking about a different scenario. They're talking about being in Knoxville, Tennessee, where they've got a home price of $100,000. Here in Southern California, where you've got a home price of $250,000, $500,000, $1 million homes, why would you want to have that much in dead money? I call that dead money because it's money that's not working for you. You need that every resource you have working for you as hard as you're working. And if you can get a safe, secure investment that's going to pay you 7, 8, 9% every single year, and I can't guarantee it going forward, but we can look backwards and say over the last 30 years, there are investments that do this. Why would you want to have it put into your house making nothing? You say, oh, Ron, but I've got to pay 4% for an interest rate. Okay, so do a little bit of math. You know, I'm the simple guy. If you can get an 8% return, you can borrow at 4%. The 8% is not going to be taxed right away, and we can show you how to do that where it's not taxed at all. And then you can look at it and go, the 4% is a tax deduction or a write-off. So you're going to maybe be paying an effective rate of around 2.8 to 3%. You take the difference between those 8 less the 3, call it 5%. That's what you're earning. Why wouldn't you want to earn that, especially if you don't have to pay taxes on that 8 right away? That's the idea of using your mortgage, using your home equity as a building block for your future. But, oh, Ron, I couldn't have a house payment when I'm retired. Why not? If you've got 8% coming in and you've got 3% going out, do you think you're going to ever run out of money? No. 5 years, every 5 years, you take the equity out of the property, you put it into these safe, secure investments. Oh, Ron, the interest rates might be higher then. So what? You'll be getting more in a return then too. That's the idea. That's the concept that we're looking at here, is how do you make this all work for you? It's called leverage. And the best piece of leverage you have is your real estate, because you're not making your return on investment based on whether you own the property free and clear. The equity in the property is going to do what the equity does. Oh, Ron, what happens if 2008 comes again and property prices go down? Well, who cares? You've already taken your equity out and put it into a safe, secure, liquid investment. So you have access to it. If it's in real estate and the equity and the property value goes down, you have no equity, you have no leverage, you have no control, because property values have dropped. That's the idea right there. We don't care about what the property values do when you've got the money out of the property. Think about that concept. That's why we're sharing it with you so often, is we want you to be in the driver's seat for your future. Great information right there. So what are we talking about here when you miss? What might you be missing when the Congressional Budget Office reported on the soundness of repealing Obamacare? Here's what the numbers are, because they're talking, the headlines out there are typical lame street media.
So I know whose ass to kick.
Yeah, they're giving you the number that doesn't matter. They're telling you 14 million Americans will lose their insurance. Well, that's not really true. That's half the story. 14 million Americans, especially being that only 10 million net gain of 10 million on Obamacare. So how do you lose 14? Well, here's the answer to that question. They will not be forced to buy something they may or may not want. They might have a health savings account that they're putting their money into, the money that's coming back to them, so they don't have to worry about the issues of buying insurance that they don't want. I've shared this on the broadcast before. I've got 3 sons. Under Obamacare, they all have coverage in case they get pregnant. Now, I was not real good in science in school, but the likelihood of my 3 sons getting pregnant is pretty slim. So why do they need coverage for pregnancy? They can go out and buy the insurance they want. Now, they're young. What insurance do they want? Do they want Obamacare where they're paying a boatload of money? No. What my recommendation to them would be is get a catastrophic insurance policy, and you use the catastrophic policy in case something bad happens. And then you use a health savings account to pay day-to-day bills. That's all part of the program. The other part that they don't want to tell you about is what was one of the big ideas of the repeal and replace. Well, it was to take and get rid of and save some money. The budget is blowing up because of the Unaffordable Care Act. Households can't afford it. The government can't afford it. The insurance companies can't afford it. Well, we're looking at saving $335 billion through the Republican plan. And people then have a choice. Why do we want the government to tell us that we have to have pregnancy coverage? Unbelievable. Think about these concepts. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, we're going to chat a little bit about mortgage interest rates. They went up again. Should I wait to buy? We'll talk about it. You can reach us anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. Connect with us, Facebook.com/Ron Siegel Radio. On Twitter, @Ron Siegel. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Stay tuned. We'll be back in just a few.
Are you living in the home of your dreams, or simply where you think you can afford? Are you earning a safe, secure 10+% return on your investments? Is your credit score over 800? If the answer to any of these questions is no, what are you doing about it? Text ATP to 79564. Complete a 3-minute complimentary survey, and the area trusted professionals of Ron Siegel Radio will reach out to you to develop a success strategy for you. Again, all you need to do is text ATP to 79564.
Isn't it time you found out the truth about FHA-insured home equity conversion? No, it's not your grandfather's reverse mortgage. This just may be the finest financial planning strategy available for all homeowners of retirement age. Helping protect what you've earned is the job of your board of directors with continued education. Major research has shown that using a HECM will significantly enhance the success rate of a retiree's portfolio and legacy. Please allow us to educate. For your complimentary consultation, call Jay Kaplan at 949-300-3855. That's 949-300-3855.
Are you currently renting a home? Do you like paying someone else's mortgage payment? Why not explore the options to purchase your own home? Can you imagine a 30-year fixed-rate loan below 4.25% APR? This means with $10,500, you can purchase a $295,000 home and have a principal and interest payment of about $1,400 per month. What are you paying in rent? Does your family deserve the opportunity to take advantage of the current market? To learn more about these exciting opportunities, the Siegel Lending Team is standing by to speak with you. Call now, 1-800-306-1990. That's 1-800-306-1990. Or visit SiegelLendingTeam.com. That's SIEGEL LendingTeam.com. Or 1-800-306-1990. Rate subject to change without notice. Licensed by NMLS ID 217037 and 145502. Equal housing lender. Not endorsed or sponsored by any government agency.
Do you have a goal of mortgage-free home ownership? What if your home was valued at $500,000? Are you aware that a free and clear home could be costing you $2,500 every month, $30,000 per year? The mortgage planners at the Siegel Lending Team would like to show you how you can own your home, generate tax-free income, and accumulate family wealth. You simply need to call the Ron Siegel Team at 1-800-306-1990. That is 1-800-306-1990. By sending the team a copy of your most recent mortgage statement, the team will send you a no-obligation real estate plan. You be the judge if this is right for your family. Again, all you have to do is send the team a copy of your mortgage statement by email to reap@ronsiegelradio.com or call today. Ron Siegel, 1-800-306-1990. That is 1-800-306-1990.
Rate subject to change and without notice. Licensed by the California DOC and BRENMLS 217037 and 145502 and Cal BRE 01869452 and 1866775.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That's my message, and as your consumer advocate, I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by Gold Star Mortgage. When you are ready for that next mortgage, veterans loans, FHA loans, down payment assistance, jumbo loans. Gold Star has all the programs that you could possibly want. Just need to give me a call at 800-306-1990. I'll put you in touch with the right people. So mortgage interest rates, they went up again. They're going to go up again tomorrow. Should I wait to buy? That's the question. Mortgage interest rates, as reported by Freddie Mac, have increased over the last several weeks. I've been sharing those numbers with you. 4.21% up from 4.1% the week before. Wouldn't surprise me to see them up again when we report that this Thursday. Freddie Mac, along with Fannie Mae and the Mortgage Bankers Association, the National Association of Realtors, all calling for mortgage rates to continue to rise over the next 4 quarters. This has caused some purchasers to lament the fact they no longer be able to get a rate below 4%. However, we must realize that current rates are still at historic lows. Give you an idea. So according to Freddie Mac, in the 1970s, interest rates were 8.86%. In the 1980s, 12.7%. 1990s, 8.12%. And the early part of the 2000s, 6.29%. The bottom line, though, you may have missed getting the lowest mortgage rates ever offered. Who cares? You can still get a better interest rate than your older brother or sister did 10 years ago, and a lower rate than your parents did 20 years ago, and a better rate than your grandparents did 40 years ago. Think about all of these different numbers that are in there, and I mean, think about the 80s at 12.7% on average. Think about just some of those numbers, and we're looking at that concept. You have to look at a combination, because if you're questioning whether you should buy based on today's interest rates, you might also want to be just looking and saying, okay, what's happening with real estate prices? And I shared with you earlier what the FHFA numbers were on where home prices were the last year as far as appreciation. But let's look at where, again, I love this survey, the Home Price Expectation Survey from Pulsenomics. And they always survey a panel of over 100 economists, real estate experts, and investment and market strategists about where they believe prices are headed over the next 5 years. Then they average the projections of all 100 plus experts into a single number. Home values will appreciate by 4.4% over the course of 2017, 3.4% in 2018, 2.8% in 2019, 2.7% in 2020, and 2.8% in 2021. That means an average appreciation of 3.22% over the next 5 years. Now, that's an important number to realize, is 3.22% over the next 5 years. I'll get back to that in a minute. Because one of the things that I want you to understand there also is when we do these surveys or report on these surveys that come out, if one economist, and I'm a big proponent of our friends over at Chapman University, when we look at one economist and we say, okay, this is what Chapman's comes out and says is going to happen in real estate values, well, they may be right and they may be wrong. They do the best. They're very accurate. But when we look at 100 different or over 100 different specialists, then what we can say is, okay, if we're getting that group and we put together 100 people, we have a good expectation that we're going to be even closer. When you put 100 people all expecting these things, we have a good expectation that we're going to get an even closer number to a more precision. So then we look at it and say, okay, let's take that group of 100 plus, and what do the most optimistic of them say? Well, they're looking at a 26.7% appreciation by the year 2021. And remember, I said when you put them all together, it's 17.3%. But what do the least optimistic say? Those would be the bears. They're saying 6.3%. Now, one of the important parts, and I wanted to get back to this for you, is, are we in a bubble? Remember I told you that the average comes out, if we look over the next 5 years, at 3.22%? What these economists are really telling us is that we're just slightly below what the numbers would have been if we go way back, if we go back 20 years or so and look at what the numbers are, our appreciation, our home price appreciation. If we go back and look at the numbers and we take out if we just put a line from, say, 20 years ago to now, and we just put a line to where we are, and we look at these numbers, the historical numbers are generally right around 3.6%. is what property appreciates in our country. 3.6% is a normal appreciation. And if we go and we take out the bubble time and we take out the bust time, we're going to see that we're really right around 3.6% straight across the line. Now, why do I bring that up? Because we're looking at now the same numbers as going 3.2% over the next 5 years. So we're really not looking at anything different than what we've looked at over time. The numbers really, they just don't change a whole lot when you take a longer survey. It's just like I said with that home price expectation survey with Pulsenomics. If you take 20 economists, you're going to come closer to hitting the mark as to how many are going to, as to what the exact numbers are going to be. Same scenario. If we look and say, okay, over the last 20 years, over the last 30 years, what have home values done? And we say it's about 3.6% historically. Well, we're going to come closer if we're looking at a 30-year average than if we look at a short snapshot. It's one of the reasons that timing the market never does wonderful things for us. It just doesn't work. Trying to time the market is not a good idea. If you miss the real best days or the best months or best weeks, you end up losing out big time. I don't want you to lose out. That's why real estate continues to be one of the best investments that we know of, one of the best investments of our time. If you want more information about any of this, in fact, we're going to post a lot of these charts right there on Ron Siegel Radio. Go to facebook.com/Ron Siegel Radio and take a look at what some of these numbers look like on there, because you need to get into the real estate game. That's the only way look at almost every major success story. Where did they make their money? They make their money in real estate. You look at the Lakers here locally. Dr. Buss made his money in real estate. Obviously, our president made his money in real estate. Many, many individuals, they've made boatloads of money by real estate. You need to be in that game as well, whatever it takes. You don't need a great FICO score. We're looking at 54.7% of the people have a FICO score between 600 and 749. 600 to 749 is 54.7% of the people. Think about some of those numbers and be sure to set that first radio preset button to come back here every day to join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Tomorrow, Wine Wednesday, and we're going to talk about buying a house with a reverse mortgage. J Capital will be here. Thanks to all of our sponsors. A big thanks to John, who's engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime. 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money, help a lot of people, have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.